What's up, everyone? Today we will compare the 6 biggest pure play defense stocks in India from a quantitative standpoint. The goal here is to come up with the PEG ratio, also called the price to earnings to growth ratio, and use that to see which stock offers us the best value in the market right now. Let's get going. So, first things first, what exactly is the price to earnings to growth ratio? So, very obviously, we divide the price to earnings by the growth rate. Now, the growth rate here refers to the profit growth rate. So we take, let's say, the profit growth CAGR of the last 10 years, and that's what we use as the denominator here. But why do we have this separate block if you already have the price to earnings? Well, the reason is the PE can vary a lot across sectors and industries. We know that HUL seems undervalued at 40, whereas BPCL seems overvalued at 8. But the PEG ratio, because it discounts the growth rate, and usually हम growth rate को ही कहते हैं ना, the reason why something has a high PE. If we expect the company to grow a lot, we give the company a high PE. But if we divide the PE by the growth rate, we're taking that factor out of the equation. So now whatever we're left with is something we can use almost universally. And that might be a big reason why the biggest investors in the world and institutions almost exclusively use the PEG ratio when it comes to checking valuations. And now we're going to go ahead and calculate it using this data. So the data you see here is basically the P&L statement for the 6 stocks that we're considering today. And I got this free of cost from Money Control. You can also do that. Using this data, we're going to go ahead and calculate the PEG ratio. I'm also going to calculate the revenue CAGR, the profit CAGR, and I use both of these to kind of judge if the company is actually growing or if they've just become profitable over the last few years. See, if the revenue and profit are both growing, I know that the company might have a bright future ahead. But if the revenue is not growing, but the profit is continuously growing, that shows that this is more of an operational improvement and that might not last very long. So this is a very basic check. Is the revenue growing in relation to the profit or not? We then follow it up with the stock price CAGR. So what this tells me, the comparison between profit CAGR and stock price CAGR, what that tells me is, has the stock been re-rated with relation to its PE, or has the stock actually increased its profits? If the stock price CAGR is a lot, like this is a lot, this is a 67% CAGR, but the profit CAGR in this case is good, but if it had been, let's say, 0.1, right? Very low profit CAGR. Then that would have meant that this stock has just been PE re-rated, which could happen because the market has a lot of liquidity or because some investors have taken interest. It could just be a trap. So if the stock price CAGR is very high, but the profit CAGR is very low, that's another trap that we might fall into. So again, we make this comparison just to avoid that trap. And this is basically that ratio here. The higher this ratio is, the worse the stock's valuation is. And I've taken it a step further by multiplying this, which I'm calling X here, with the PE to call, well, the golden ratio, let's say, right? It's not something that exists in finance. This is just something that I use to judge valuations, because this brings in all the information about valuation. It's using the PE ratio, it's also checking the stock price CAGR, it's also checking the profit CAGR. So the higher this ratio is, the worse the valuation of a stock is. And this is my basic analysis, right? Before I get to the PEG ratio, I'm going to go through all these checks just to qualify कि PEG ratio में कुछ गलत नहीं मिल जाए मेरे को, right? Sometimes the PEG ratio might show something very good, whereas the company hasn't actually done great. For example, let's say the company's profits have been growing, but the revenue hasn't been growing. That won't reflect in the PEG ratio. The PEG ratio might still be very good. But revenue growth nahi hai, meaning the company will probably not do very well. So I want to make these checks as I go forward just to avoid some traps. Now, how do we calculate all this, right? So the formula is pretty simple. It comes from the compound interest calculator. So we know that compound interest may number of years and rate of interest come in as a power, right? All I have to do is take that rate of interest out. So इस equation को realign करना है कि हम rate of interest की value निकाल पाएं instead of the value of the final principal amount, right? And that is simple algebra. The formula comes down to this. What I'm essentially doing is I'm taking, for revenue CAGR, I'm taking the final revenue, which stands here. I'm dividing that by the initial revenue, right? So you can notice here, we have the C column here. So this is C11, let's say, right? I'm using the net revenue. So I'm using C11, you can notice here, C11, and I'm dividing that by L11, which is the initial revenue. And that is taken to the power of 1 by 10. So जब हम compound calculate करते हैं, right? जब हम forward compound calculate करते हैं, we take the power to 10, the number of years, right? When we're going reverse, where we now need to calculate the rate of interest, the power reverses. It goes from 10 to 1 by 10. You don't need to understand this. If you do, that's good, because going ahead, this kind of algebra should become a little elementary. But if you don't, just memorize this formula, right? So as soon as I put that power to 1 by 10, I get a value in 1 point something. जो भी something 1 के बाद आता है, that's basically the rate of interest, right? Now I'm subtracting 1 from that ताकि मेरे को pure interest मिल जाए. Because 1.6 थोड़ा difficult है to calculate with, right? I'm just subtracting 1 from that, and that's my final answer. Here revenue CAGR comes down to 0.06, which is essentially 6%. Our profit CAGR is 0.22, which is brilliant. 22% profit CAGR for a company of the size of HAL is enormous. HAL is the one we're evaluating first. The stock price CAGR is pretty high, 67% is a lot, but because profit CAGR be high hai, and there's a lot of visibility for HAL, I'm okay with that. Now stock over profit growth at 3, I have to accept, because again, HAL is a big company, could just be an exception. The golden ratio is okay, about 100, I'm again okay with. And finally, we get to the PEG ratio, which is basically me taking the PE, जो भी current PE है HAL का, and dividing that by the profit CAGR. That's about all it is. So the current P of HAL stands at about 36. I've divided that by this cell, which is the profit CAGR, and multiplied that by 100 to get the PEG ratio. The multiplication with the 100 is because here I have not already multiplied with 100, right? We should be multiplying the growth rate in percentage terms. And I get a PEG ratio of 1.6, which by basic economic standpoint is high. PEG ratio should be 1, but 1.6 for a market like India, especially the kind of liquidity we've seen, is not very high. Now I've calculated the same for the rest of the stocks, and then just so that we understand it better, I'm representing it visually here. So the first thing we look at is the PEG ratio, and we can see HAL has the lowest PEG ratio, which makes it, just from basic mechanics, the cheapest stock out there, followed by Mazagon Dock and so on and so forth. I've also created a graph to check the revenue versus the profit growth. So the orange is the profit growth, whereas the blue is the revenue growth. And we can see that the biggest mismatch here comes with BDL, where the revenue has declined while the profits have grown. So that's a stock I would never invest into. No matter what this company has been promising, their revenues have not grown over the last 10 years. That's not a company to invest in. That's just out. And that was the purpose of this first check, right? To make sure I don't fall for any traps. Then the second check is the profit growth versus the stock price contribution. And here we can see that the best bet here comes to be BEL, just ahead of Cochin Shipyard, Solar Industries and HAL. But Mazagon Dock here doesn't seem to be very promising. The idea simply being that the stock's growth, the stock price's growth has been very sharp compared to the profit growth. That in a way means that इसमें जो consolidation होगा ना, that has to be longer unless something dramatically changes, because the market has priced in too much growth before that growth has come in. The market is just a discounting mechanism, right? It's looking at the future and thinking how much profit will this company make, and based on that it gives it a price. Here the price is too far ahead of the competition, and obviously BDL is the worst performing here as well. We'd already eliminated it. Here we also eliminate Mazagon Dock as a potential investment avenue. Moving on, we then come down to the PEG ratio. And the best PEG ratio we have is for HAL, as we've already seen, followed by Mazagon Dock, Cochin Shipyard, BEL and Solar Industries. And within all of these, I feel like anywhere since from BEL is okay. The PEG ratio isn't too high, especially because the defense sector is growing, the government has an intense focus on it, and the visibility of their revenue is pretty strong. So I would be okay investing into any 4 of these, but solar is again a little too expensive. So we've already eliminated BDL, even here it's the worst performer. We eliminated Mazagon Dock because the stock price growth had just been too high. And now finally, we've also eliminated Solar Industries. We're only left with 3 possible stocks to invest into: BEL, Cochin Shipyard and HAL. Now, for the final chart, we have the golden ratio, something that I just used. And again, we can see that BDL performs the worst, Solar the second worst, Muscat Dog the third worst. This basically just confirms our hypotheses. And we're left with these three, wherein for me, my pick would be HAL and BEL, not Cochin Shipyard yet. The simple idea is that the company's stock prices move too much for me, but that's a very individual call. I would think that any of these three would make great investment bets for the next 10 years, unless something changes politically in the country and we lose our focus on defense. That's a macroeconomic threat that this particular model cannot address. But I hope you understand what we tried to do here, and I'll give you a quick recap. We started off with this data, sourced free of cost from Money Control. We calculated revenue, profit, and stock price growth. That gave us an understanding of how much this company's stock price has already taken into consideration in terms of the company's growth. And therein we saw that a couple of stocks were just eliminated. Then we used the profit growth and the current PE ratio to calculate the PEG ratio. And all of this we charted here. Using this information, all the information that we calculated, we said that there are three stocks that do not make good investments from this model's standpoint. That was BDL, Muscat Dog, and Solar Industries. We were then left with three companies, all three of which I'm okay with investing into and one of which I'm already invested in. The companies being HAL, BEL, and Cochin Shipyard. That was the model in brief. I hope it made sense. And if there's something in particular that you want to ask, or if there's a model that you want me to make about a sector, or just something that you need to understand about how all of this works, let me know in the comments. I'll see you next time.